Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about ways you can use your tax-free savings accounts as you approach retirement and in your retirement years as well. So we'll give you some, I think, great tips to think about when you're looking at your tax-free savings accounts. Now, if you're new to our channel, make sure that you hit the subscribe button and notification bell. We're posting content all the time, quite literally in all aspects of retirement and wealth planning. So as you likely know, tax-free savings accounts are a very versatile account to have when it comes to our financial planning. And during our income earning years, before we retire, we can use tax-free savings accounts for things like education funding if we want, maybe to fund holidays, emergencies that may come up from time to time, home purchase, and as well, we can use our tax-free savings account as a way of saving money for our future retirement. Now, sometimes when I talk about using tax-free savings accounts as a way of saving for retirement, I get this raised eyebrow because most people think in terms of pension plans, their government benefits, and their RSP accounts that eventually get converted to registered retirement income funds. But the tax-free savings account can be a really important supplement or component to your overall plan. So I'm going to talk about how you look at your tax-free savings account in the context of that overall plan. Now, the best way of really thinking about the tax-free savings account initially, particularly as it relates to retirement, is just think about where your tax brackets are. So I've got a very quick example. Let's say that through your your earning years, you're earning income that puts you at roughly a 40% marginal tax rate, and then as you look ahead, you believe that your tax bracket's going to drop when you retire. And that's what I find with most clients. So I find that most clients will drop 1 to 2 tax brackets when they retire because they can begin income splitting a lot of their income with their partner. So RSP accounts make an awful lot of sense when we can deduct that contribution to the RSP at a 40% marginal tax rate, and then down the road pull the money out at 25% at, let's say, a lower tax rate. So in that situation, the client gets a tax deduction, pays tax, so they're arbitraging the difference between saving taxes at 40 and paying tax at 25%, and then they get tax deferred growth. The compounding of the assets in the account are not taxed, or the earnings aren't taxed until you begin drawing money back out. So to get clarity on this particular area, it's important to do some forecasting. There is a link in the show notes that takes you to our retirement coaching page, and there's a video that talks about our forecasting and our retirement coaching. So by looking into the future, you can get a sense as to, do I do the TFSA for retirement, or do I make an RSP contribution? What makes most sense? So it just depends on your circumstances, and of course circumstances can change over time, so you have to adjust. So what circumstance would lead you to use your tax-free savings account as your primary vehicle to at least begin funding your retirement, as opposed to an RSP account? Well, the main determiner, again, is tax brackets. So I've just got this illustration here where, let's say you're looking today and down the road, you're always going to be at the marginal tax rate, let's say roughly 40%. Or you're always going to be at a marginal tax rate of roughly 25%. Now what that means is, unlike my previous example, when you deduct for an RSP contribution at 40%, that's the savings, 40%. And down the road, when you take money out of the RSP, you're going to pay 40%. So the only benefit really is you're going to compound value at a tax-deferred basis within the RSP. And I guess you could argue that because of the time value of money, you're paying those future taxes with dollars that cost you less because they're inflation adjusted. But ignoring those things, if I'm not getting any win, if I'm not arbitraging the tax brackets like my previous example, I want to first focus on funding my tax-free savings accounts. That should be your first priority. So strive to maximize your TFSAs every year, because then you're going to get the power of tax-free growth, tax-free compounding, and you can take the money out tax-free, and there's all kinds of benefits attached to that. So when you're trying to triage which strategies make most sense, you want to make sure that for your retirement, you want to make sure you're funding your TFSAs to the maximum, particularly if your marginal tax rate is not going to change, and you want to invest in such a way that you can maximize the growth. And we've done other videos on that topic as well. Now, the other thing about tax-free savings accounts is not just, do we use it to fund retirement income, but we also take a look at what are the uses for TFSAs once you're retired. So what are some examples? Well, one example could be you decide to invest surplus cash flow. So what I find sometimes is clients will have RIF payments. Let's say they've deferred taking their RIF account until age 72. They convert at age 71, and that's additional income. They don't need all of it. So they might take some of that after-tax income from their RIF account and push it into their TFSA. Maybe there's some rent income, maybe some contract work, and they want to find a place to park that money. There could be a situation where you might have non-registered or open accounts, and you transfer those to the TFSA. So we have that situation very, very often. So we have a lot of clients that have open money or non-registered capital, and then every year, because they're retired now, their cash flow is a little bit less. They're pushing money from their open account to their TFSA and making sure that they're funding the limits every year. Now, the one thing you have to be careful about is, will there be tax trigger, capital gains triggered when you do that? But even where tax might be triggered, if you can move money that's in a taxable account to money being in a tax-free compounding account like a TFSA, it probably makes sense to absorb a little bit of tax along the way to get the money pushed into the TFSA. And the other reason is if you're retired and you can increase your income without bumping your income into another tax bracket, it could make sense to take additional money from your registered accounts, your RSP or RIF accounts, pay the tax, and then push that money into the tax-free savings account. So what you're doing there is trading off tax-deferred compounding to tax-free compounding. The cost of doing that is you might have to absorb a little bit of tax to get the money out of the RSP or RIF, but as you project down the road, you hit a crossover point where it makes more sense to compound value tax-free than tax-deferred. So it would be another example. Now, another way the tax-free savings accounts can be used is as a legacy tool. So we have clients who set up tax-free savings accounts. They're fortunate because their pensions and government benefits and RIF accounts and RSPs are sufficient that they don't really need their tax-free savings accounts to fund income. So they view that as a legacy asset that will eventually go to their kids. The kids can be listed as beneficiaries on the accounts, and eventually that money can just go on a tax-deferred basis or tax-free basis to their children, and it doesn't have to be probated if there's a beneficiary on the account. Another reason, though, is that sometimes clients view their TFSAs as providing additional liquidity for the estate. So in that situation, the money would go to the estate upon death, and then they'll use that money to look after taxes or liquidity needs in the estate, or to fund charitable donations they want to make as well. So as you can see, the tax-free savings account is just a really versatile financial instrument to use both before you retire and throughout your retirement years. Now, to get more resources, make sure you go to the show notes. There's links to various resources we put together for retirement planning and wealth planning generally. As well, I've created a playlist, so if you want more content on tax-free savings accounts specifically, make sure you go to that playlist. Now, if you don't want to miss future content, hit the subscribe button and notification bell so you're alerted to the regular content that we put together on an ongoing basis on topics around all things retirement and wealth planning. You take care.